All right, so this is chapter 8, section 1. This chapter also doesn't have a lot of sections, but what we are doing is getting the last section of the kind of unit. We'll have a reinforcement activity after this chapter to kind of tie everything together. And how we're doing and what we're doing is we're trying to get ready for the next fiscal period, and we need to do this. And how we do this is we need to get our accounts balances to where we want them to be. And so we're going to have these things called closing entries, and we are going to close temporary accounts. We got to know what are permanent, what are temporary, and why we need to close them, and then how to do this. So it's a kind of involved chapter. I would strongly encourage you to read it. There's a ton of information in here. And so we'll start first with need for temporary or permanent accounts. Okay. First, where are we getting this stuff? The worksheet we used to help us with journalizing adjusting entries. And we also prepared some financial statements from the worksheet. Well, we're also going to help us use this worksheet to help us with our closing entries. Okay. Permanent accounts. What are these accounts? Accounts that we will continue to have balances next fiscal period are called permanent accounts or real accounts. Okay, and the permanent accounts are assets, liability, and the owner's capital account. Not drawing, the capital account. So all the assets, all the payables, and capital are permanent accounts. You'll need to know that. The ending balances for all these assets, liability, and capital accounts, or the permanent or real accounts, for one fiscal period, the ending of one fiscal period are the beginning balances of the next fiscal period. Okay, we got to take our bills with us. We take all our capital with us. We take all our assets with us. We just adjusted the assets to make sure they're up to date. And so the permanent accounts, assets, liability, and owner's equity, we're not going to, or capital, we're not going to touch because they are permanent accounts. But accounts that are used to put information in and dealing mainly with the capital account are called temporary accounts or nominal accounts. Okay, and what are these? These are the income statement for the most part. Revenue, expenses, and then the drawing account. Revenue expenses are our income statement, but then we also add the drawing account. Now, we haven't used income summary. That is also a temporary account. Okay, so when assets or real accounts are permanent accounts or real accounts are assets, liabilities, and capital. Temporary accounts or nominal accounts, these are revenue, sales, all our expenses, and drawing to go along with the income summary. Okay, temporary accounts show the changes in the owner's capital for a single fiscal period. When we begin the new fiscal period, we want all these temporary accounts to have zero balances. And that's what we'll do when we do closing entries. We will take all these temporary accounts, we will take sales, all the expenses, drawing, and income summary, and get them to zero. Because all temporary accounts need to start the next fiscal period with zero. All right, so why are we doing this? Journal entries to prepare temporary accounts for new fiscal period are called closing entries. These are the temporary accounts, must be back to zero, so we kind of just talked about it, a little redundant. But closing entries are the journal entries to get our accounts balances to the next fiscal period where we want them. And what we want is the temporary accounts to have zeros. And we do this to match our expenses with revenue, otherwise we'd go on and we'd have all these expenses at the beginning of our next fiscal period when it wasn't true. We couldn't compare one fiscal period to the next. So we want to get all our expenses, revenue, drawing at zero, along with income summary to zero when we start the next fiscal period. And that's what they're saying here. New fiscal period, we want to have them start with zero. To how do we do this? To close a temporary account, an equal amount must be recorded on the opposite side. So for example, if account has a credit balance of $3,565, we need to debit it to record and close it so that we get zeros. And hopefully that makes sense, and we'll show you some T accounts that'll help you with that. All right, so we haven't touched income summary. Here's the income summary. What is it about? We used to always say income summary is a dumping ground. We dump all the closing entries into it. We already talked about how temporary accounts need to be closed. A closing entry of equal debits and credits must be there. And we're going to help us do this by using income summary. It's a temporary account that's helped be used to close the revenue expenses. Income summary doesn't really have a normal balance, like assets is a debit, expenses is a debit, capital is a credit, sales is a credit. It doesn't have those normal balances. Income summary is unique. It does not have one. When revenue is greater than total expenses, which means you have a net income, which you found on the worksheet in the income statement, the income summary account has a credit balance. When revenue is greater than expenses, income summary would have a credit balance. When total expenses is greater than revenue, which means a net loss, the income summary account has a debit balance. When expenses are greater than revenue, income summary will have a debit balance. You'll need to know those for some true-false questions, so hopefully you can write this T account down or understand it a little bit. Income summary, when you have a net income, credit balance. When you have a net loss, it's a debit balance. So how we're going to deal with and use income summary is we're going to close these temporary accounts into it, and we'll end up with the net income or net loss. And also because income summary is a temporary account, and it will need to be closed as well. Okay, so we'll use it to help us close sales, close expenses, and then we will have to close it itself. The 4 closing entries we're going to have is we're going to have an entry to close income statement accounts with credit balances, which means if you wrote the word sales, that's sales. We're going to have an entry to close the income statement accounts with debit balances, which are the expenses. And we're going to close those into income summary. Then we will record net income or net loss with income summary, meaning we're going to close income summary. Because income summary, after we close sales and after we close expenses, the balance of income summary shows that we either have a net income or a net loss. And then we will close income summary. And then the last closing entry is to close drawing. Where are we going to get this information? We're going to get these to record all 4 closing entries in the income statement and balance sheet columns of the worksheet. Okay? So, little example of the worksheet. The first closing entry is we would close all income statement column accounts with a credit balance, which is sales. So the first closing entry is we're closing sales. So if our idea was that whatever the balance is, $5,820 is a credit, and we have to do the exact amount, just do it on the opposite side, we would then, to make a closing entry, we will have to debit sales for the amount to get it to a zero balance. So the balance was $5,820. Our closing entry is a debit to sales so that we can get the balance to zero. See how they equal out, so you get to zero. You'll put closing entries as a heading in your journal, and then you will put the credit of sales into income summary. And you can see that effect there. So what is the first closing entry? Is to close income statement accounts with credit balances. And that's what we did. We closed sales. How do we do it? We debit sales, credit, income summary. The balance of sales is now zero. It's ready for the fiscal period. That credit's put into income summary. All right. Just a reaction or just a thought, I guess. Most small businesses use the whole calendar year, December 31st at the end of the fiscal year. Matches up with the calendar, especially small businesses. That's just kind of an FYI. It's nothing incredibly earth-shattering. We kind of talked about how we want to do it when it's not busy, but small businesses often will just end on December 31st. The second closing entry is to close all income statement accounts that have a debit balance. And this shows you all the expenses have debit balances. So if we got to do the equal amount on the opposite side, we then will credit all of these. So advertisements, $397 debit, we will have to credit it. And we do that for all these expenses. You add them all up and you put the total into income summary. So we put sales into income summary as our first one. And then the second closing entry is to close all the debits or expenses. So we close them and we put the total of all of these into the income summary. Okay. Now the expense accounts have the normal balance 0 for the next fiscal period. They're ready to go. Okay. We put the remainder in income summary. So this is kind of just explaining what I told you. The balance of each expense account is returned to 0 and we're ready to go. So you can see we had a balance here. We closed it doing the exact amount on the opposite side to get 0. Balance here, closed it 0 for all of our expenses. Now income summary, you can see we closed sales or revenue, the income statement credit account. We put $5,820 worth of sales. We had closing expenses of $2,658, which are expenses that we did for all these. So the balance, 5,820 minus 2,658, gives us a new balance in income summary. This balance, this number, is our net income. So that should be on the next slide here. Net income of 3,162. You can see that is represented in the income summary. Sales here, expenses here, the difference, 3,162. Means when there's a net income, remember at the beginning, when there's a net income, income summary has a credit balance. Okay, so that net income number equals, that's a great thing about accounting, everything equals so you understand it. So the amount of net income increases capital, right? And if you're thinking sole proprietorship, it's your company. So when you make money, that increases capital. How do you increase capital? You credit it, correct? You have to credit it. So that's what they're telling us here. So whenever there's a net income on the worksheet, okay, whenever there's a net income on the worksheet, that means that income summary has a credit balance. We said income summary is a temporary account. So how do we close income summary? We have to do the exact 3,162 balance. We have to do it on the opposite side. So whenever the worksheet has a net income, when we close income summary, I always think net income is good for capital. What's good for, how do you do that? You credit capital and then you debit income summary. I always think of the capital part. Now you can memorize what income summary is a net income, then that means it's a credit balance, and then you have to do the opposite, which is debit it. But when I see net income here, I know I got to close. I got to put all that net income into capital, and I close income summary that way by debiting it. So to close, the third closing entry is closing net income, record net income or net loss. This is a net income. Income increases capital, which means you credit capital. We debit income summary. We close income summary out. So you can see in the T account, closing revenue, closing expenses. This was our balance. 3,162 we closed. Now we have a 0 balance. We were able to put all the net income into our capital. Now we have increased our capital, which is a good thing. Okay? And that's what we're talking about here. The debit to income summary reduces its amount to 0, and income summary is ready for the next fiscal period. Again, income summary is one of the temporary accounts. Sales, expenses, income summary, and drawing. If there was a net loss, the closing entry would be a debit to owner's capital, right? If this was a net loss, that's bad for capital. Well, how do you know? How do you do something in lower capital? You debit it. So if it was a net loss, we would flip-flop that entry. And the entry would be a debit to capital and a credit to income summary. Okay. Amounts from the closing entries are taken from the income statement, balance sheets, and income statement and balance sheet columns of the worksheet. That's just something that's normal. I guess you can go down here too and kind of see what we're talking about with those steps, but not bad. The fourth closing entry. First one, we closed sales in the income summary. Second one, we closed expenses in the income summary. The third one, we closed net income or net loss, which closes income summary, into the capital account. And our last closing entry is to get rid of drawing. Drawing is a temporary account that has a debit balance. So when we close drawing, which you see in the balance sheet part as 1,150, we drew out that much money, which means we lower our capital by that amount. How do you lower capital? You credit capital. How do you get rid of an expense that we're trying to, or a debit that we're trying to close out? If you get rid of a debit to close, you must credit it, just like we did with the expenses. Okay, so the drawing account's a temporary account. It accumulates over that fiscal period, which is our month. We need to get it reduced to zero. So how do you get rid of a debit? You credit it. And drawing lowers capital. How do you lower capital? You debit capital. Okay, and that's what they're telling you here. And when you do this, the capital's new balance of 4,012 is the amount that we would actually see on the balance sheet. So the two amounts are the same. That means the capital account's been verified. So you can see here we had a $2,000 balance. We closed net income. Then we closed drawing. Our new balance is 4,012. And by crediting drawing for the amount of that, 1,150, we have closed drawing. This 4,012 should be the same number that you used on the balance sheet. And so now you've closed all four accounts. Closing the income statement accounts credit balances, we closed sales. Close the income statement accounts with debit balances, we closed expenses. Those will never change. We record net income or net loss by closing income summary. If it's a net income, you increase capital by crediting it, so you debit income summary. If it's a net loss, you would decrease capital by debiting it, and you would credit income summary. And then you always close owner's drawing account, how you did here, with the credit to drawing and a debit to capital. Okay, so the first two and the last one never change. This one is all dependent on if it's a net income or a net loss. That is section 8.1.